Capital budgeting part 1. Problem 1. An investment opportunity costing 180,000. Find the net present value of the investment at the cut-off rate of 12%. So we are using the NPV, or the net present value, as well as the payback period to assess if a project or an investment is profitable and worth investing for. So let's solve for NPV of this investment in problem 1. So given its cost 180,000 and a net cash flow of 60,000 for 5 years. So if you look at it in a layman's perspective, obviously you will say that in 5 years' time, my 180,000 will become 60,000 times 5, 300,000. So 180,000 versus 300,000. So you might think, okay, I earned 120,000. But of course, we have to consider that you will be receiving the whole 300,000 only after 5 years. So we have to consider the impact of the present value. Given here is the present value factor for 12% for 5 years, the 3.605. So let's compute the NPV. NPV is the net cash flows minus the cost of the project. And it's, NPV is equal to the present value of cash flows minus the investment costs. So it's 60,000 times present value. So our present value factor is 3,605. In actual problems, these present value factors are not given. So please check my other videos as to how to compute the present value for ordinary annuity or annuity due or simple present values. Minus the investment cost of 180,000. And that is 36,300. So this project is profitable. Next problem. Find the payback period of the investment. Number 1, the net present value. So after computing the present value of our cash flows expected from this project, then after deducting the 180,000, we still have an excess of 36,300. So number 2. Another way of evaluating a project is computing its payback period. When are you going to recover your investment? So payback period is simply your total investment divided by your annual cash flow. So it's just 180,000 divided by 60,000 per year. 60,000 annually. So that's 180 divided by 6,000. That's 3 years. The meaning, okay, take note that payback period doesn't consider present values. So we can say that disregarding the effect of the interest of 12%, we can recover our investment in just 3 years. Since you will be receiving cash flows of 60,000 for 5 years, so this is still a good indication that after recovering, you still have 2 more years of cash flows coming from this investment opportunity. And that's our answer for problem 1. Problem 2. Capital budgeting part 1, problem 2. Compute the annual net cash flows for the investment. Given this data, you're looking for the net cash flows. So, assuming that you invest in this machine, your expected annual savings in operation costs is 18,000. So, letter A, savings or annual savings. It's 18,000. 18,000 cash savings. So net cash, we're looking for the net cash savings. So that means when you save on operations costs, your income will increase. Consequently, your taxes will also increase. So your taxes will be your savings, which is 18,000 less your depreciation. Of course, you have your increasing income, but also your expense, depreciation, which is annual straight line depreciation of 10,000. So minus 10,000. So your net increase in income, your net increase in income is 8,000 times our tax rate of 40%. So you have 3,200. So your income increased by 18,000, but you have a depreciation of 10,000. So that means your net taxable income is 8,000. Your income tax for the period is 3,200. So that means your net annual cash flows is 14,800. That's our answer for letter A. Next, compute the net present value of the project. Again, the same thing as we did in problem 1. NPV is equal to the present value of all cash flows times the present value factor given here. So, letter B. NPV. Again, NPV is equal to the net cash flows, which is 14,800 times present value factor of 5,650 minus your total investment, or cost of the investment is 100,000. So equals negative 16,380. So your NPV is, this is negative. So it is not a good investment when you have your investment, when you evaluate X. So when you evaluate that your NPV, your project's NPV is negative, it is not a good investment. So that's for capital budgeting part 1. Problem 7. So we have here a company, RAS company, considering replacing a machine that has the following. Question letter A, requirement. Find the net investment required to replace the existing machine. So if we're going to replace this machine, the replacement cost is 300,000. So that's the first thing we are going to consider. Replacement cost. We have to come up with 300,000. The question is the net investment required. If we are going to replace this machine, we are going to dispose the old machine. So let's compute the proceeds. Its current market value is 160,000. So the old machine, if we are going to sell it, the selling price is 160,000. Deduction. We are looking for how much we're going to cash out for this replacement. So if we are going to raise 300,000, then we will be selling this at 160,000. Then the balance, that's what we're going to invest. So aside from this value that we are getting from the old machine, again, based on our problem 1 and problem 3, we are also getting savings from selling our properties at a loss. Its book value is 200,000 and we sold it at 160. So we will have a tax savings. So we will compute it here separately. Tax savings. Our book value is 200,000. Our selling price is, or market value, is 160. So we incur a loss of 40,000. Again, once we incur losses, we will get tax savings. So times our tax rate of 40%. So we will have 16,000 tax savings. So this is a cash out, cash inflow as well. So you have 300,000 coming from your 300,000. That's the net amount we're going to raise. Then we sell something. We sold our old machine. So that's 160,000 less. Then another 16,000 tax savings. So all in all, we are just going to cash out 124,000. That's the net investment we are going to make if we are going to replace our old machine with this new one. So 124,000. The next question is, compute the increase in annual income taxes if the company replaces the machine. Compute the increase in annual income taxes if the company replaces the machine. To solve this, it's best that we compute first the depreciation of the old. Depreciation here is not being given. Depreciation of the old asset and the new asset. That's critical in our computation. So for our old machine, depreciation, it's 200,000 divided by 4 years. Remaining useful life 4 years. So that's 50,000 per year. This is the depreciation of the old machine. Now, for the depreciation of the new machine, 300,000 4-year life. 300,000 divided by 4. So that's 75,000 per year. Old machine, 50,000 depreciation per year. New machine, 75,000 depreciation per year. Again, our requirement is increase in annual income taxes. Increase in annual income taxes. If the replacement of the machine would save us 37,500. Okay. Letter B. Savings. 37,500. Depreciation. The new machine depreciation is 75,000. The old machine's depreciation is 50,000. Based on our computation, again, we are looking for the increase in annual income taxes. So, to get the increase in annual income tax, we will solve for the increase in income. And it's coming from the savings minus the depreciation. Okay. We consider the old machine's depreciation because the issue here is what is the net increase assuming that we replace the machine. Look at the problem here. If the company replaces the machine, so that means this is still part of our consideration. If we are going to replace, what is net effect? So the depreciation here is 75,000 for the new. The old machine's depreciation is 50,000. That means the net depreciation is 25,000. So your net increase in income is 12,500. The net increase in income times our tax rate of 40%. That means our net increase in taxes. So our net increase in taxes is 5,000. Compute the net increase in annual net cash flow. The annual net cash flow. So, letter C, increase in savings. This is cash. Given in the problem, this is cash. 37,500. Another cash outflow is 5,000. Increase in tax. So our net cash inflow is 32,500. Cut. Cut. So, to answer letter C, compute the net increase in annual net cash flow. Net cash flow. Letter C. We have an increase, a savings of 37,500. Take it, this is cash. 37,500. So we have savings. This is cash of 37,500. And we have increase in tax. Increase in taxes. 5,000. So we have 32,500 net cash inflow if we choose to replace the old machine with this new machine that costs 300,000. Thank you.